The banking crisis was solved the wrong way, because what happened when Silicon Valley Bank collapsed was that the Federal Reserve decided to change the way in which secure deposits are made whole, and decided at the same time to provide liquidity to banks in order to prevent bank run coming from the unrealized losses in sovereign bonds. However, that did not stop deposits from falling, and deposits are coming down and are at the level that was not seen in the past 2 years. So a big slump in deposits, but at the same time an increase in credit. So banks are lending more despite the loss of deposits. The confidence, therefore, in the overall economy remains relatively stable. It is also important to understand that in the United States, 80% of the real economy is not financed in the banking channel. It's fundamentally financed via bonds in the private market, by private loans and different instruments that are outside of the banking system. It's important to also pay attention to what is happening in Europe. European banks are stronger than they were in 2008. Certainly, they have improved their core capital ratios, and they have a number of liquidity injections and different cushions that allow them to strengthen core capital in an environment of weakness. All of those things are positive. On the negative side, the most challenging element is the exposure to sovereign debt, which is very high. Exposure to sovereign debt makes banks more vulnerable to a situation in which the governments are increasing their imbalances and making it worse to repay their debt. So that's why the ECB continues to be extremely accommodative. I think it's also important to understand that in the euro area and the European Union as well, according to the IMF, about 80% of the real economy is financed via the banking channel. So banks are much more important for the real economy in Europe than they are in the United States. We have to look at all those things at the same time, because the perception that everything is solved and that nothing is happening is very dangerous, and that the banking crisis is a symptom of the excess that was implemented in the past years with negative rates and with massive liquidity injections. So banks are not the cause, they are a symptom, and we need to think of what are the ramifications for the real economy. So far they seem to be limited, but the credit crunch is inevitable.